Mastercard has gone up over 100% since the lows in 2022. And in this video, I want to go through their business model, their moat, their services, see how their revenue is produced. Then I want to go through their historical financials and their most recent earnings report, and then wrap it up with a valuation and see if potential investors in Mastercard can get a good return on their shares or not. So if you like this content, please like and subscribe. I recently opened up a Substack publication. It's called Beard and Bull Markets. Anyone can join for free. It's on Substack. Go there, join up. You'll get some free articles on, commodities and other types of markets. Great market analysis for everyone. If you feel so inclined to subscribe, you get access to the entire bearded investor community. This includes my Patreon, my stock buys and sells, my deep dive stock analysis articles, and the full Discord community. So if you like that, please subscribe there, but you get value regardless of whether you're a paid or free member. And now with that, let's get into it. Now, Mastercard's business is structured around its core payment network, which includes the processing transactions, the domestic cross-border fees, and stuff like that, and also the rapidly growing value-added services, which includes data analytics, cybersecurity, their loyalty programs, and consulting. And so this section and subsection of their revenues is rapidly growing and increasing into the future. But these segments work together. They leverage the data from the payment network, the masses of data that they get from all of those transactions, to offer specialized tools for businesses, governments, and financial institutions. There's so many people who use Mastercard or indirectly use Mastercard services that it's kind of ridiculous. And even on their website, you can see that they connect individuals and organizations in more than 210 countries and territories today. So they're truly a vast global corporation. Mastercard powers economies and empowers people worldwide. With our customers, we deliver a wide range of payment choices, making transactions secure, simple, smart, and accessible. Our core payments and commercial and new payment flows work so that everyone everywhere can participate in the digital economy on their own terms. This, combined with our value-added services, are responsible for acquiring, engaging, and retaining customers by managing fraud and risk, enhancing cybersecurity, and improving the digital payments experience. So this is a $500 billion company, more than a $500 billion company, that has been around for a long time and is globally used for a lot of individuals, governments, and financial institutions. Now, when we're looking at the moats for Mastercard, there are plenty. So the first one, and probably the biggest one, are their network effects. They've been around for a long time. The more customers that Mastercard has, the more merchants accept it, and vice versa. So you have more merchants, then more customers come to use those merchants. Oh, I have this, this, this. And so one variation of a customer will want option A, merchant A, and then customer B wants merchant B. So the more you have, the more options and flexibility you can offer to your customers. And then the merchants see that you have a vast trench of customers. They're more likely to spend and advertise with you than a competitor. So the network effects really go hand in hand and build their global moat. The next one I would say is intangible assets. They're a globally recognized, trusted brand. Everybody knows who Mastercard is and probably has used their services at some point. I know I've had Mastercard credit cards before and used them before. Even if I saw their logo, I would instantly recognize it. So these intangible assets are very valuable in this type of industry. And then there's high switching costs. Financial institutions face significant costs and complexity integrating their Mastercard infrastructure. So if they want to switch to something else or another competitor's, really costly for them and probably not worth it. So they're going to stick with Mastercard. And then economies of scale and cost advantages. It's super vast. As I mentioned, it's global, used in 210 countries by individuals, governments, financial institutions. It's not going anywhere. So it's so established that it allows for durable cost advantages over somebody who tries to get into the space, smaller players. And finally, it's a capital light business. A large portion of their revenues is just transaction fees. So there's no cost of goods. You're just getting transaction fees from all these people who are just using your product and service over and over and over again. Really need for marketing, once you have become this entrenched, you don't really have to ramp up. You're not a startup. You're not scaling up like that. They're used by billions of people. And so they're really capital light and don't really need a lot of capital investment to generate high free cash flow and return. So how do these moats actually play out? The first thing I can point to is pricing power. Mastercard can charge higher fees than a smaller competitor because they're just the most powerful. You might lose out by not using Mastercard. So the second would be the self-reinforcing flywheel. And here you're seeing every transaction strengthen the network. This is the network effects that I talked about earlier, making it more indispensable over time. Third, they are adaptable. They can switch with future technologies that get implemented. So Mastercard has successfully navigated technological shifts like chips in their cards, contactless payments, digital wallets without losing relevance, showing its moats resilience going into the future and evolving with technology. Then finally, it's the dominant market positioning. Along with Visa, it holds a near monopoly in many areas of payments and payment networks, creating very high barriers to entry for any competitor who's trying to get into the space. I can't even imagine a smaller player that's just starting up competing with MasterCard or Visa at this time. Like, it's basically the forest, and if you think of a small seed as a competitor, how is that seed going to grow their business with all of the shade from Visa and MasterCard preventing them from growing? It's really not going to happen. And so that's kind of the near monopolistic position that they're in right now. Now, this analysis wouldn't be complete if we didn't look at what bulls and bears are saying and any headwinds for MasterCard as well. But let's go through what the bulls are saying on fiscal AI. Here, they're saying that MasterCard historically has outperformed Visa in terms of growth. Its smaller size and some leveling in the market share between the two could maintain this trend. There are still plenty of runway for the growth in electronic payments. Electronic payments only surpassed cash payments on a global basis a few years ago. And then management is appropriately focused on long-term growth opportunities and not near-term margin. But then bears are saying that MasterCard is a distant number 2 player in scalable industry, which could hamper long-term margins. The oligopolistic nature of the industry makes Visa and MasterCard a target for regulators, and the companies have historically paid some large fines. And Union Pay provides an example of how governments could favor local networks, and this could shut MasterCard out of some emerging market opportunities. So let's go through these bear cases one by one and break them down. Now, looking at this chart, you can see that Visa clearly holds the lead in credit cards in circulation by percentage in the US as of May 2025. And they have about 20% lead in that space. There are some minor competitors here: American Express, Discover, JCB. MasterCard has 37.5%, while Visa has 57.5%. And this is as of last year. And so that may have changed, but you can see that there's still growth to be had. I wouldn't say that they're a distant number 2 player in the scalable industry. Since it is scalable, they could still grow that by getting more customers, more industries, financial institutions with them over time. Has to play out whether it will hamper their long-term margins. They still have room to grow as the number 2 player in a scalable industry. Now, for number 2, the nature of their monopolies on this industry, Visa and MasterCard, is a target for regulators, just like the monopolistic natures of the tech companies, the major Mag 7 tech companies, where in Europe, Google's getting hit, Meta's getting hit. A lot of these big multi-trillion-dollar companies are getting hit overseas and sometimes in the US. The same goes for Visa and MasterCard. It's not just isolated to the tech industry. So this could be a legitimate bear thesis. But to this, I would say that this happens to all companies when they become extremely successful in their industry. So that to not invest because you're scared of regulation, because a company is too successful, doesn't make sense. And finally, for the third bear argument, this is a possibility. And this could shut down Mastercard, but it will shut down not just Mastercard out of some of these emerging market opportunities. It would shut down Visa. It would shut down some of their competitors too. So let's look at some of the metrics for Mastercard first before we get into the historical financials. They have over a $500 billion market cap at $520.77 billion. Their enterprise value is $529.12 billion. And the difference here is pretty much their debt or the amount of cash they have on hand. So here it's about a little less than $9 billion. And you can see here that their net debt is about $8.34 billion. So that tracks. But their cash on hand is $10.65 billion. So they're well capitalized. Their shares outstanding a little less than $1 billion at 900 million. They have about $31.47 billion in trailing 12-month revenue. And they have about 35,300 employees. Now, this really stood out to me when I was looking at their margins and doing the research for this company, but their gross margin is 100%. This means they have zero cost of goods sold, cost of services sold. So all of their revenue comes down to their gross profit, which is amazing. Their EBITDA margins are 62.3%. Their operating margins are 58.9%. Really, really, really high margins here. Their pre-tax margin is 55.9%. Their net margin is 45.3%. And their free cash flow margin is a 54%. Their PE is 37.1. Their price to book is 66. Their EV to sales is 16.8. Their EV to EBITDA is 26.8. Their price to free cash flow is 30.6. The next 12-month price target from analysts is 657.37 based on analyst estimates, and their forward PE and PEG are 29.7 and 2.9 respectively. The PEG ratio being 2.9, it ideally should be closer to 1 to make sure that you're getting a good deal, a good undervalued company. Under 1 would be undervalued. Near 1 is fairly valued, and over 1 is getting overvalued. So depending on how far away from a PEG of 1 it is. So 2.9 is not crazy overvalued, but it isn't super undervalued, just based on this metric. And PEG is just the PE ratio divided by the growth rate. So now let's get into the actual historical financials. Let's look at the trends that we can find and talk about. So total revenues, you're seeing the revenue just go up and to the right. In 2015, it was around 9.667 billion. And now in the last 12 months, you're getting 31.474 billion. Incredible growth there for the last 10 years. The gross profit margin was 100%. So all of this is basically just their revenue. The revenue and the gross profit charts would look identical. SG&A has been going up over time. Depreciation and amortization have been going up over time. Other operating expenses has been going up over time. So the operating profit has also been going up. That's great to see. And then let's look at their consolidated net income is going up over time. And it was 3.8 billion 10 years ago, and now it's 14.25 billion for the last 12 months. Their EPS has been going up steadily. No real disruptions you can see in their metrics. It's been going up and to the right pretty much steadily. There's no major fluctuations besides maybe a little bit of COVID, distortion in 2020, 2021. Now let's look at something that's really important, is their total shares outstanding. Are they reducing their shares? And they are. 10 years ago, they had over 1 billion shares, and now we have closer to 900 million shares. They've been steadily buying back their shares and reducing their share count, which is great to see here. Let's look at their balance sheet and how healthy their balance sheet is. Here you can see that their cash and cash equivalents is around 10.3 billion for the last 12 months. Their total is 10.648 billion. Total assets sits at 53.289 billion. Total liabilities is at 45.37 billion. So they're well capitalized and their balance sheet is healthy. So the difference between their total liabilities and total assets is the total shareholder equity, which is sitting just under $8 billion for the last 12 months. Now let's go to their cash flow statement. Here it starts with the net income at 14.25 billion for the last 12 months. You can see D&A came in at 3.1 billion. Share-based compensation expense, or SBC, was 593 million. That's how much their share-based compensation, stock-based compensation is. And their unlevered cash flow is $17.26 billion. Levered cash flow, which takes into account their debt, is $16.992 billion. So all in all, if you're just looking at their straight up free cash flow, it's about $17 billion for the last 12 months. So now let's look at what they did in this quarter. So in their third quarter 2025 financial results, the latest one, they did $8.6 billion in net revenue, non-GAAP, and $7.369 in non-GAAP 2024. So that was a year-over-year growth of 17%. Currency neutral is 15%. Their adjusted operating margins is 59.8% over 59.3% last year, which is a 0.5 percentage point increase. Adjusted net income came in higher at $3.961 billion versus $3.593 billion, which is up 10% year over year. And adjusted diluted EPS came in at $4.38 versus $3.89, which is 13% up year over year and 11% currency neutral year over year. Effective tax rate was a little higher this quarter versus last year's quarter at 21.4%. versus 16.3%. So they broke down their third quarter gross dollar volume, or GDV, worldwide, United States, and the rest of the world. So worldwide, they had 9% growth in GDV at $2.747 trillion. And of that, they had $1.476 trillion in debit and prepaid GDV, and then $1.271 trillion in credit GDV this quarter. Now, breaking that down into the United States and the rest of the world, you saw 7% growth in the United States. And here they had $819 billion broken down into $395 billion from debit and prepaid and $424 billion from credit. The rest of the world accounted for 10% of the growth. And here you had $1.927 trillion in third quarter of 2025, $1.081 trillion from debit and prepaid, and $846 billion from credit. Revenue generating segments, payment network, and value-added services and solutions. So in third quarter, you saw $5.179 billion, which is 12% GAAP growth in their payment network. And in value-added services and solutions, you saw $3.423 billion, which is a 25% GAAP growth, 22% currency neutral growth. So total net revenue, $8.602 billion, 17% growth GAAP, and 15% growth currency neutral. So really amazing growth here. And you can see that their value-added services and solutions is growing really well, over 20%. And their core payment network is still growing strong, double-digit growth. And compare this to like a PayPal, you're only seeing single-digit growth in PayPal. So this is growing strong. Third quarter key metrics related to their payment network versus last year's quarter. You're seeing growth across the board. Domestic assessments, growth, cross-border assessments, transaction processing assessments, all up year over year. I want to see both the core being strong and staying above 10% and staying double digit. And then I would love to see more growth in the value-added services and solutions segment. Now, out of that last earnings report, they also announced a quarterly dividend, continuation of their quarterly dividend, and a $14 billion share repurchase program. So management is also very aligned with the shareholder returns, capital allocation, and giving back to investors of their company. So Mastercard Incorporated today announced that their board of directors has declared a quarter cash dividend of 87 cents per share, a 14% increase. So here they're increasing it again at 14% over their previous dividend of 76 cents per share. Cash dividend will be paid on February 9th, 2026 to holders of record as of January 9th. So January 9th is the ex-dividend date for this company. They also, more importantly, approved a new share repurchase program authorizing the company to repurchase up to $14 billion worth of their Class A shares, common stock shares. The new share repurchase program will become effective at the completion of the company's previously announced $12 billion share purchase program as of December 2024. As of December 5th, 2025, the company had approximately $4.2 billion worth remaining under the current approved share repurchase program. So they have really been buying back. They bought about $8 billion of their shares back since December 2024. And now they have another $14 billion available in the share buyback authorization. So that brings them to about $18.2 billion worth that they can buy back into the future. So this is really cool. And I'm sure the management is going to take advantage of any dip in the share price to buy back their shares. So let's move on to valuation. For valuation, I'm using Simply Wall Street because they have a really nice excess return model. Now, the reason I'm using the excess return model instead of what I normally do with the DCF model analysis is because Mastercard has exceptional profitability. Their return on equity, ROE, is anywhere from 195 to 211%. And that's vastly higher than the cost of its equity, which is the required return. This means the company is very, very, very effective at using shareholder capital to generate profits. And you saw their margin numbers. That's why they're so profitable and so efficient. Gross margins were 100%, and their other margins were very high as well. So we have to use the excess return model instead of the regular model to evaluate Mastercard. Keeping that in mind, we go down to the valuation section on the Mastercard on Simply Wall Street, and we're seeing that they get a fair value of $742.25. And the current price, this is not updated, the current price is around $565, not $575. So this is even greater than 22.5% upside in this name. And when we look at how they arrived at this number using the excess return model, you can see that they used an unlevered beta of about 0.829, probably for a financial services company like Mastercard. And they re-levered that beta to the new beta, which is around 0.901. They used that beta in the discount calculation to get the appropriate discount rate of 7.42%. Then they plugged that discount rate into the excess return model, and with the percentage of their stable return on equity, which they derived as 213.8%, super high. That's why you're using the excess return model, minus the cost of equity, which is 7.42%, times the book value of equity per share, which was $14.68. They derived a excess return of $30.29. And they found the terminal value of that excess return and added those two together, and they were able to get $742. So that's it, guys. That's my valuation and analysis of Mastercard and the company. I looked at their business model, Moat. I looked at some headwinds. I looked at some news, I looked at the historical financials and the most recent earnings report, and then finally I wrapped it up with the excess return model valuation on Simply Wall Street. If you like this content, please like and subscribe, and like I said at the beginning, I do have a new Substack publication out if you want to follow that for free, and if you feel so inclined to get even more value out of your investing, you can also subscribe as a premium member. But that's it, guys. I'll see you guys in the next one.